All right, thank you. Thank you for your time.
It's my pleasure.
Yeah, let's talk about when you have clients and the emotions and the stock market volatility. How do you deal it? I think that people also need a little bit hand-holding, right? When there is a stock market crisis or a crash or a correction.
They do, Tim, and I think at the end of the day you need to help educate your clients. And we try to do that at the beginning when we first meet our client. We discuss a long-term approach. We tell them that capital that we manage that goes into the equity markets should only be capital that you don't need for a minimum of 5 years. So if you need the capital prior to that, you really shouldn't be investing in the stock market, and we simply won't take the money. So we also try to educate the client in terms of through our letters. We have 30-page letters that we send out twice a year. We talk about our long-term approach. We talk about patience. And again, it's really important that the client understands it has to be capital that they don't need for a reasonably long period of time.
And when it comes then to a correction or to a bad situation, how, do you get then more calls, phone calls, or?
You know, ironically, Tim, I've been asked that before. In March of '09, we only got one phone call.
And you could calm those people down, that person?
Yes, we did. We did, yep.
And so your clients understand it, right, pretty much then?
They do. And don't forget, Tim, in our business, virtually all our accounts are balanced. So we only have 1 or 2 accounts that are 100% equity. The majority of our accounts, almost all of them, are balanced, meaning we have fixed income. So for example, when valuations rise, as they have over the last 5 or 6 years, what we have done, we have reduced our equity allocations for virtually all our clients. So if they had an 80% equity allocation, today they might be at 60. In the first half of this year, we sold all our Bed Bath & Beyond, and that had grown to a 10, 12, 14% position. We sold all our Mercury General, and we lightened up on several of our holdings that have done very well in this last 5 or 6 years of the bull market. We sold 10 to 20% of Mohawk, LabCorp, United Health Group, and Martin Marietta. And so as a result, that's another benefit that we have that can kind of shield the clients from being, you know, overexposed to the equity markets.
And what is your typical client look like? So they are probably pretty wealthy?
Yeah, the majority of our clients are high net worth individuals and families. Our average account size is 3 to 5 million. Now we certainly have several smaller than that, but we have several quite much larger than that. And we manage all separate accounts. The money's custodied at Schwab, and then it's all separate accounts.
And so you do it then personally, like you talk the goals through with the client, each one?
We do. When we first meet with a client, Tim, we really try and focus. Our goal is to build a lifetime and a generational relationship with that client. We're not interested, we're not a hedge fund, you know, with a shorter term orientation. We don't leverage. This is basically, our firm is structured for the long term, to build long-term relationships with clients, to preserve their capital, and secondarily growth and income based upon their needs. And so because we want to build a lifetime relationship with them, in many cases we manage a large portion, for many of our clients, of their liquid net worth, which is one of the reasons we have balanced accounts. You simply can't have it all in the equity markets, and there's many clients that need income, etc. So that's really our approach. And when we meet with clients, before we even discuss managing money and investments, we really spend quite a bit of time trying to truly get to know them, their needs, their goals, learn about their lives, learn about their careers, learn about their personal life, learn about their family. So we really try to build a relationship with them beforehand, so that they understand what we do and that it will be a good long-term fit for both of us. Mm-hmm. You know, I mean, and Tim, 3 of the questions we ask after we learn about them, tell them about us, 3 of the questions we ask are, the pool of money that they're interested in having us manage, what is the primary purpose or goal of that pool? Second, what's the time frame on that pool? We like them to have a 5-year or longer time horizon. And then third, they should not, they shouldn't invest and exceed their risk tolerances on an emotional level and on a financial level. And what I mean by that is there are some clients that may be very affluent, but the stock market really scares them. So you could, you wonder, should they even be in the stock market if they're going to get nervous with all the volatility. Then there's other clients that may not be as, as financially well off, but for them, it might be a $500,000 or $1 million account or more. For them, they want the preponderance in the stock market. So emotionally, they're well prepared. So again, those are 3 of the questions that we ask to try to get to, the heart of the matter, what the client really wants and needs.
And so once you know it, so the typical one for you is 60-40, 60 equities, 40 bonds?
I would say our typical is probably 60 to 80% equity, and then 20 to 40% in fixed income.
Yeah.
Yes.
And your holding period of the single equities, how is your strategy? It's pretty much value investing, right?
It's value investing. If you look at my training at Ruane Cunniff and with Chuck Royce, it's long term. Our holding period is typically 10 years or longer.
And your turnover within the portfolio?
Very low.
Very low?
Very low. It's less than 5%. For sure, less than 10%.
Okay. And then the stocks you pick, what are your favorites? Can you talk about a few? You mentioned Bed Bath & Beyond, for example, you
Yep.
sold out, right?
Yep.
What do you like? What's your favorite?
We're a generalist. So we'll look at a variety of industries and a variety of companies. We're also global. Now we will invest, we have limitations. We will invest in Western Europe. We've looked at Japan and Korea. So typically the developed economies is where we focus, where we really don't have an edge in China or India or Eastern Europe. But those are the countries that we focus on, and we're generalists when it comes to looking at individual companies. But we typically try to buy companies that we think are unique, have dominant or leadership positions in their industry, typically earn high returns on capital, are not highly levered, and are run by management teams that we've studied for many, many years and are good at both managing and operating the business on an operating basis, as well as very good on the capital allocation side.
What's one of your favorite stocks?
Some of our key holdings would be Berkshire Hathaway, U.S. Bancorp, Progressive Insurance, Mohawk Industries, LabCorp, United Healthcare, Martin Marietta Materials, Zoetis is a big holding, and we recently bought, in the first 6 months of this year, we bought Precision Castparts, and that's been recently acquired by Mr. Buffett.
Are you happy with that? I think there was a more than 20% premium, right, on the stock price?
Yeah. Now, I think Mr. Buffett paid 12 times EBITDA. The stock fluctuated from 270, 280 at the high to down to the 185 or so range. And his paying $235, I think, when you look at the earnings for Precision Castparts, they lowered their earnings estimates. There are 3 factors that contributed to that. A facility in Morgantown, Pennsylvania had an explosion. The oil and gas business is the big reason, has really come down, and that has significantly negatively impacted them. And, at the end of the day, that is, of all the issues, that's clearly the biggest one. The oil and gas industry really going down. But I think when you look long term, I think Mr. Buffett got a very, very good deal because the earnings are currently depressed. The third issue is Rolls-Royce was going through a transition and brought on a new CEO. And as a result, they've been doing some inventory destocking. So that's a third reason why their revenues and earnings have been impacted. And Rolls-Royce and the Pratt & Whitney division of United Technologies both account for, I'm estimating, it's less than 10% of revenue, but it's a meaningful portion of their revenue, whereas GE's engine business is, I think, 13 or 14% of their revenue. So when someone like Rolls-Royce is destocking on the inventory side, it really hurt them. But I think we felt long term, again, Tim, when you look out 5 to 10 years, we thought it was a $300 to $400 stock over time. They dominate. There's many, many products that they supply that are highly, highly engineered, high temperatures. They need approval from the FAA. There's very few people that do what they do. So I think it's going to be a great deal for Berkshire.
Yeah, and they're also protected. They have, how does he say, a competitive advantage because of long-term contracts with their clients.
They do. They have a very Boeing and Airbus buy engines from those three major manufacturers that I mentioned: GE, Rolls-Royce, and United Technologies, Pratt & Whitney division. And as a result, there's enormous demand for aircraft. I think there's almost 40,000 aircraft on backlog, and about 14,000 are to replace existing aircraft. So there's an enormous need for engines, and about 70% of Precision Castparts business is in that space. And again, highly engineered, specialized product. There's very few people that can do what they do.
So there are people that criticize Buffett. They say he has lost his touch after 50 years of doing well, but they criticize, for example, IBM didn't do well and he still, increases. They say he buys food factories and people want now have fresh foods and produce. So they say, and then newspapers, they're shrinking or slowly,
I mean, I find it really interesting, Tim. Throughout Mr. Buffett's career, as he's gotten larger and become more and more successful, it amazes me, and this isn't just now, it's happened repeatedly, where people say he's lost his touch. I think that's absolute nonsense. I mean, I can vividly recall in 1999 and then March of 2000, Berkshire Hathaway stock, it was one of the times he thought about buying it back. I think the A's got down to 40. There weren't A's then, but my point is that what's A's now? I think it got close to $40,000 per share. And he was viewed as having lost his touch because everyone was making all this money in technology. And he was buying paint companies and furniture companies and so forth. Again, just like now, he was proven to be clearly correct. He didn't suffer by buying businesses that were grossly overvalued that he didn't understand. I think one of the things that people, don't really understand about Mr. Buffett, he has enormous patience and he has incredible discipline. He never steps outside his circle of competence. And in all the years that I've studied him, and I've been studying him since I was 12 or 13, and I'm 55 now, so it's a long time. And certainly I wasn't as knowledgeable when I was much younger as I have been over the last 30 years. But what's astounding to me is not only the success that he's achieved, which everyone focuses on, but when you look at his investments, the investments that he's made throughout his lifetime, even going back to when he started his partnership in 1956, what's astounding to me is how few true mistakes he has really made. And he talks about, the mistakes he's made all the time in his annual reports. The shoe company that he bought, Dexter, he sold it, he bought it, and he gave Berkshire stock. Dexter's worth virtually nothing, and the Berkshire stock is worth several billion. But if you look at his investing career from 1956 to today, 65 plus years, the number of mistakes he's made are so few that it's truly astounding. And no one focuses on that, Tim.
What's his secret? If you could summarize it, like, how can you get to that performance? And
I think it's a multitude of factors that have contributed to his greatness. His sheer hard work, his singular focus, his native talents and abilities that came from above, they're extraordinary. And he's also unique in the sense that not only is he really brilliant mathematically, which has really served him well throughout his career, he also has the other unique combination of having extraordinary people skills. And most people are really talented at one or the other. And there's varying degrees of talent on the analytical side and on the people skill side. And he is probably in the top 1% in both of those areas. So that's what's astounding. Most people, you know, you're a good salesman, and so you rise to be a really great salesman, but oftentimes you're not very good analytically. Then there's other people that are very good analytically, and there's obviously various grades of quality in analysis. He's at the top echelons in analysis, and he's at the top echelons in people skills. And those two unique gifts have contributed enormously to his success. And one other point, Tim, that's really interesting, when you study Mr. Buffett's career, another thing that's really incredible is how he has evolved both as a human being and also as an investor. He began buying nets. He began being very mathematically oriented in '56, following the Ben Graham approach, buying companies that were statistically cheap. But throughout his career, as the financial markets have changed and Berkshire has changed, he has grown and evolved. So he went from the nets and various arbitrage situations in his partnership. Then when he met Charlie Munger and got to know him, Charlie convinced him that he should be buying better businesses rather than cigar butts. So in the early '70s, he started buying the Washington Post, pieces of that, and Geico, and some of the food companies, General Foods and others. He started buying better businesses and paying a little bit of a higher premium, if you will, than what he did historically, because he recognized that high returns on equity with good growth opportunities and a long runway, you can pay a higher price and you still come out way ahead. And then he evolved to buying entire companies, buying all of Geico in '95, buying other public companies, and buying entire private companies. Private companies where the owner didn't want to sell to private equity, because if you sell to private equity, they're going to have to take you public or sell you, and many of these long-time owners did not want to go public either. So they didn't want to go public, they didn't want to sell to private equity. Berkshire's the perfect home for them. And so he bought a lot of those companies. And then obviously there's even another evolution. During the crisis in '08, '09, he did all those deals with Goldman Sachs and GE and others, buying warrants. So the point is, I think there's a confluence of factors that have really contributed to his extraordinary success. And he just has a really broad and unique set of talents that really, I don't think that level of talent exists in any other human being that I've ever studied.
And from who else have you learned a lot besides Buffett, personally?
I've learned by studying a lot of the great investors. I learned a lot working for Chuck Royce in small caps. I learned an enormous amount from Bob Goldfarb and Bill Ruane and Rick Kniff, as well as the late Carly Kniff, Greg Alexander, the team at Ruane Kniff, terrific people, great investors. I've also learned a lot by reading, and I've met many of these people. Howard Marks, I like reading his material, all of Ben Graham's books, and I try to read voraciously. And many, many other very successful money managers. The late George Michaelis, I remember reading his Source Capital materials for years. Lou Simpson, who used to work for Mr. Buffett for 30 years. I used to read his 13Fs beginning in the early mid-'80s. Chieftain Capital is another firm I admire a great deal. Glenn Greenberg, and they're separate now, but Tom Stern, John Shapiro, the guys at Tweedy Brown, have a great deal of respect for all of them. So I've learned from a lot of different people.
And when you would look at your company, what is your largest holding? I think one of them is Berkshire Hathaway.
Berkshire's still the largest.
And then what comes then next?
Berkshire's the largest, and then we have several holdings that are a little smaller than Berkshire. Wells Fargo, which we've owned forever, is huge. Progressive is large. Mohawk is large. Lowe's, the retailer, is very large. LabCorp's a good-sized position. So virtually all these positions are anywhere from 5 to 12% or so of our assets. Berkshire's close to 20.
Which one is your favorite right now? One, or let's say very strong.
I still, even though it's come down a little. Berkshire, the Bs were in the 150s. Now they're 133 or so as we speak. I still think Berkshire is worth meaningfully more than the current stock price.
It's 1.3 times book value right now.
Yeah, the Bs ended the second quarter at roughly $100 in stated book. And I think the Bs are easily worth $170 to $180 for the Bs. And so at 133, I think that's a big discount.
I think he bought back at 1.2 times book value.
Yeah,
a few years ago.
at 1.2 times. Yeah. And the Bs should end this year, barring a catastrophe in reinsurance. The Bs should end this year at 106, 107, 108, and probably next year at 115 to 120. And so the reality is, if you look at 1.2 times those numbers, the stock price is almost there now.
And they're like, he has put this family business at the old price still in the books, right? He doesn't increase the book value of them.
No.
So it's very conservative book.
Well, the reality is the stated book value grossly understates. So like Geico's on the books for $2 or $3 billion, if I recall correctly. Geico's probably worth 25 to 45 billion. Okay, so the reality is they're very conservatively accounted for, and the intrinsic value of those businesses keeps growing. So we think Berkshire is just a great, you've got diversity, you've got the most brilliant investor who ever lived at the helm, you've got enormous cash position, he won't go below 20 billion, and I think the world, there's 190 plus billion in global debt. The one thing, Tim, that really scares me is the global debt, not only all over, the developed world, the emerging markets, the US, we're at 18 trillion here. There's just enormous debt. And the reason I'm raising that is I think there will be other challenging times ahead, and that will create more opportunities for Berkshire.
But still, the stock is almost on a 12-month low, right? Or it's close.
It is. It's very close.
What's the reason?
I think people don't, he doesn't pay a dividend, so that excludes many large institutional buyers. And frankly, Tim, I think, and I don't think he needs to pay a dividend now, but I think if they ever chose, when Mr. Buffett is gone, if they ever chose to pay a dividend, I think, and this is a financial separate issue, it's not a fundamental issue, I think the stock price, if they ever paid a dividend, would rise significantly, because there's literally trillions of dollars out there that simply won't buy it because it doesn't pay a dividend. And so I think not paying a dividend is one. I think the concerns of him passing, he turned 85 on August 30th. Charlie was born in 1924. He'll be 92 this January 1st. I just think there's concerns that he won't be at the helm, so that would be a second issue. The third issue, it's not easy for people to really understand it. You have to really study it and follow it and look at the individual businesses in there. And that's another point that I would make, Tim. If you broke, and I'm not saying they will or they should, but if you broke Berkshire apart and you started valuing each of those individual businesses on a fundamental basis, I mean, the price is significantly above. Significantly. If the A's today are 200,000, you could make the case pre-tax, if you broke it all up, it's worth 400,000 to 500,000. That much.
Yeah.
So there's a lot of value there is my point. But people don't understand it. The age issue and the dividends, I think, are three of the reasons why it's come down.
Yeah. And besides, you mentioned like other companies you like a lot. Which one you would like to talk more about, like Wells Fargo, or which one is the most interesting right now, you think, to look at, because it's
we love Wells Fargo and U.S. Bancorp. We think they're the two. Wells Fargo is 1.3 trillion. U.S. Bancorp's approaching 500 billion. We think Wells Fargo and U.S. Bancorp are two of the finest banks in the world. If you look at the fundamentals, the efficiency ratios for both, U.S. Bancorp just announced, I think yesterday, their efficiency ratio is always 51, 52%, amongst the lowest. Wells is 55, 56, 57. And they're achieving these efficiency ratios with net interest margins that are way down. Wells was at 296. U.S. Bank was at 303 or 304. The other thing about both those banks that's extraordinary, not only their cost position, but 50% or so of their revenues is not net interest margin. It's other businesses, which protects them. Whereas if you're a smaller bank in a community, the majority of your business is really net interest margin. You don't have those non-interest based businesses, mortgage originations and servicings, credit cards to any degree, etc. So I think Wells is interesting. Wells should earn 415 to 420 this year. So the stock's roughly 50, 51, 52. So 12, 13 times earnings. U.S. Bancorp should earn 320 or so this year. Stock's 40, 41. So again, both of them are 12 or 13 times earnings. I will not buy the bigger investment banks, J.P. Morgan, even though they're good operations, Citigroup, Morgan Stanley. I like Wells and U.S. Bank. They don't do any investment banking in terms of trading, foreign, fixed income, currencies, commodities. They don't do any of that. So I think they're more conservatively run. I like both of them. I like Mohawk. Mohawk has really surprised us. It broke 200 a while back. It's in the 190s today. They should earn $10. The stock had really declined during the crisis into the 20s, and we owned it prior to that. And then we bought some more. So Mohawk we still think is attractive, although it's certainly not cheap. But we still like Mohawk. We've only sold about 20% of it. We like LabCorp. They bought Covance, so there's a little bit of risk. It's a little bit of a different business. We still like Progressive. We think when you look out 5 or 10 years and you look at Progressive, they just came out today with numbers. Their numbers were terrific. We think in 5 and 10 and 15 years, Progressive and Geico, we own Geico through Berkshire, we think Progressive and Geico are just going to dominate the auto space. We have 4 children. They're never going to go to an agent. They're going to buy it from Geico or Progressive.
Is it an internet?
Internet, auto insurance, they're going to buy it direct. So we like them. We're looking in the healthcare space, but several of them have, we like World Fuel. World Fuel is a logistics company and a fuel broker, if you will. So, I mean, we like what we own, but I will say it has not been easy finding compelling opportunities in the last year or so. It's much harder than it was.
And what do you think about the market? Is pretty much like up for 6 years? And
yeah,
people warn a little bit. They say it's a little overpriced, a little pricey at least, people say.
What I would say is a couple things. I simply don't know where the market will be a month from now, 2 months from now, 6 months from now, 2 years from now. What I will say is the S&P this year should earn 115, 118. This year maybe 125 next year. I think the market multiples, if you look at the S&P and Dow, are in the 15, 16 range, which is not dissimilar from the historical averages. However, there are other factors that are an issue. The Shiller PE using 10-year smoothing is in the mid-20s, which is quite high. Interest rates are artificially low, which is another issue. Profit margins are exceedingly high, amongst the highest they've ever been. And frankly, I don't think consumers, investors, really have many places to invest their money. So I think that's impacting the stock market. People have nowhere to put their money. Fixed income globally is very, very low. So many people who otherwise shouldn't be in the stock market, I think, are investing in the stock market to get the dividends from stocks. But having said that, I also think people are very concerned, and they still remember the crisis of 08, 09. And a lot of institutions have pulled out of the market and they're going to alternative investments. So it's kind of a mixed bag. On the one hand, I think the market's fairly valued to a little overvalued. And then there's pockets of meaningful overvaluation. Biotech and pharmacy, some of the social media. But then there's other areas that are not as overvalued. So it's a very tough thing to say overall where the market is. But I would say it's hard to find compelling values.
And yeah, what is then? So you drove down a little bit the equity, right?
We have. We have. We've driven down the equity partly because we felt Mercury General and Bed Bath had reached their intrinsic values, and we felt the risks going forward did not justify the current prices. So we sold both of them, and we lightened up, as I mentioned, on Mohawk, LabCorp, United Health, and Martin Marietta. And part of the reason we've lightened up is the multiples on all of those stocks have really expanded. The earnings have also grown beautifully, but we just felt it was an appropriate time, given their valuation levels, to take 10 to 20% or so of the profits off the table for our clients.
United Health is an amazing performance. I think the stock went up 40,000% in the last couple of decades.
It has. It has.
What did they do so greatly compared with the other insurance?
That's a great question. United Health, and this is an example, Tim, of a mistake I made of omission, which I've done many. We could spend 2 days talking about all my mistakes, but I met Bill McGuire and his team back in the early 90s at United Health, and my colleague and I, Andy Nieder, we traveled the country and met with a lot of the HMOs, Foundation Health and Dan Crowley in Sacramento, and just all of them. Len Abramson at United Healthcare in Philadelphia, WellPoint and Len Schaefer in LA, Anthem, Cigna. We met with all of them. And we also met with some private companies, George Halverson at Health Partners in Minneapolis and others. And what was interesting was back then, and I unfortunately wasn't smart enough to capture it then, despite it being all over the interviews, virtually all the other HMOs were using an insurance mentality, loss ratios, etc. And what was different about United Healthcare, and especially Bill McGuire, was Bill would look at healthcare needs and the healthcare industry and go build businesses around those healthcare needs. Now, what do I mean by that? When people look at the HMOs today, they focus on commercial insurance, which is very mature. They focus on Medicare, Medicaid, and those types of businesses, which United is amongst the largest in all of those. However, what Bill and his team did, he built a great team, they built these 3 Optum businesses. Those Optum businesses are the most rapidly growing part of United Healthcare. They're the most profitable part of United Healthcare, and I think there's enormous value in all 3 of them. I would love to see United spin them out, maintain the relationship with United, and keep 80% ownership. For example, the old Ingenix, which is now United, one of the Optum businesses called Optum Insight, is doing over $4 billion in revenue, generating 20% margins, and those businesses sell for 2, 3, and 4 times revenue. It's one of the most outstanding businesses I've ever studied. They're the leader in healthcare information. It's just a great company. They also own a PBM, a pharmaceutical benefit manager, at United. They're the 3rd largest behind Express Scripts and Caremarks, which is owned by CVS. So they brought in the Medco business. So they have a huge pharmaceutical benefit manager business, and that's also worth a great deal of money. So what was unique about United was they looked at the industry differently. They built unique businesses very differently than the rest of the industry. And had I been wise enough to capture that in the early 90s, we would have made a great deal of money. However, we did correct the mistake, and we have clients that have paid 20 and 25 for it. And more recently, I gave a presentation 2 years ago, over 2 years ago, January of 13, during Obamacare, when that was coming out, and the stock was 52. And we ended up getting some there as well. And I believe today it's in the 120 range or so.
And so you meet the managers personally. You go to analyst days and stuff, and
I do.
To the companies also directly.
What we do, Tim, is we're generalists. We believe that the numbers aren't enough. So we read the annual reports for a couple decades for many of the companies we're looking at. We try to read the analyst reports and the annual reports and all their material from their competitors. We meet with industry thought leaders, but we spend a lot of time out in the field talking to competitors, customers, former employees, anyone that we think can really give us unique insights into the industry, into the people, and into the business model. And in addition to doing that, another point that I think differentiates us, we don't do a lot of the work on the phone. The phone is only preliminary. The majority of the work we do, we try to do in person. So if we meet a competitor or a customer or a high-level former employee, we do it in person. We just find building those relationships is far more powerful.
So the top-tier management is difficult to get because they're so busy, right? Or
No, that's not true. Many of these companies have analyst days, and you have access to them. And we typically only go meet the management if we know, if we've done that preliminary work. We just won't go meet the management after we've read the numbers. We like to do quite a bit more due diligence. And you can get a lot from the numbers. You can read the proxy, see how they pay themselves. You can see how they spend shareholder money in terms of dividends, stock buybacks, acquisitions. So you can learn a lot from the numbers, but we like to go beyond that.
yeah, is it your assets under management? Can you talk about that?
Yeah, we're managing 130 million today, just a little under that. They're all separate accounts. I review all those accounts regularly. Every account I review every weekend, and our trader Mike Allman reviews them virtually every day. And so, you know, we just want to, we don't spend a lot of time marketing. We spend most of our time doing research. Most of our clients come from word of mouth.
And that, again, about the typical client, is like a family that has a business or so?
Yeah, that's
like
a great question. Our clients are really three segments, if you could broadly. Portions from executives that I've met over the years, maybe 15%. Another 15% is older women that trust our firm. And then the remaining 70% or so is really small and medium-sized business owners. It's really entrepreneurs. And we represent, they have enough business risk, we really represent, in many cases, a large